Well, the thesis is around a whole bunch of technologies that are all coming together at the same time, whether it's artificial intelligence, robotics, EVs, green energy, genetic sciences, all of these things, plus crypto. And these things are all driven by what's known as network effects. So network effect business models, for people who aren't familiar, think of Facebook and think of what happened to the share price of Facebook. And that's because as more people join the network and then build businesses or interconnect on the network becomes more valuable. And it's different to the discounted cash flow model of the world that we all grew up with. It's a network model of the world, and it actually works really well. These charts all look ridiculous and everything looks like a bubble until you put them into a logarithmic chart, and they all form these beautiful trends with higher volatility, but absolutely phenomenal returns. And what that's all about is the future value of the network. So once you start, the first great network adoption model that most of us grew up with was the mobile phones. Mobile phones, when you had one or two mobile phones, they're pretty valueless. But once you start getting 1,000, 1 million, 10 million, 100 million, then the value of the network becomes exponential because suddenly you can do so much. And we've seen that, then the rise of smartphones and then the apps that get built on. And so if you were to add all the mobile phone networks around the world together, you've got, a multi tens of trillions of dollar asset here. But that's happening here, particularly with crypto, because this is the network of money and of digital value. So it's an incredibly powerful incentive because if you remember the Facebook version, the users benefited by being able to connect with people and also getting the dopamine response of likes and all of that stuff. But that was all we got. The network got all the money. So Facebook shareholders got rich. The difference with things like crypto is the users are the owners. So if you own Bitcoin, you actually own a part of the network. So that's why it becomes incredibly powerful. So that's really what this is based on. So I started realizing that this was all a network effect business model. And I started modeling Bitcoin, and it worked by using the number of wallet addresses. Then I started modeling Ethereum, and it exactly fitted too. And Ethereum, the network's growing faster because we've got so many developments on top of the network, much less on Bitcoin. So we've got a huge growth in the network of new people joining it, and then all of the network connectiveness of these new businesses. And we've seen the rise of NFTs and the rise of DeFi, in the last year. And so it's working perfectly within this Metcalfe's law model. But then I started realizing, what I then realized is you start to see some other breakout tokens like Solana and, let's say, Terra. So I modeled those. They're also exactly following network adoption models. And then what's really spooky about it all is Ethereum is exactly following even time and price and chart pattern Bitcoin in 2017.
Wow.
But Solana is exactly following Ethereum 2017. And if you remember what Ethereum did last time around, because it's earlier in the network and the exponentiality is larger. So I'm starting to realize that the whole space is the same thing. And that is a key for us all to be able to understand how to value this stuff. What's real, what's not? It's simple. It's the network.
And what do you think is driving some of these values? Is it just pure price speculation? Is there value there? Is there interest? What is it that is bringing these folks into the various networks?
So we talked about Ethereum, which is rich and deep as an ecosystem. So everyone gets that. So why Solana? What's going on there? Well, Solana first was price speculation, and then suddenly applications start getting built. There's NFTs being built, there's DeFi being built, there's stuff going on. So if developers are moving onto the network because it's cheaper and faster than Ethereum, slightly less decentralized, that's the trade-off. You can really see the value is being driven by the network adoption model, and that's super clear.
You have this global macro heritage or background. How much of these, like when you look at networks and communities, it's really about the behaviors of people. How do those two marry together when you take your kind of macro hat and these network adoptions help? Does it hurt? How does it work together?
I think at first most macro people didn't see it. I didn't either. In fact, none of us really did, because these all look like bubbles. Most of us missed all of the FANG stocks because they always traded expensive. We thought this is faddy. We didn't understand the value of networks. So I think macro missed all of that. But last year, when these things started taking off, it started making us think, okay, what is going on here? And I really had to question my own belief system about mean reversion within markets, what it means, because network stocks tend to mean revert to the exponential moving average. They don't mean revert to the average, right? It's very different. Like natural gas prices are exploding right now as we're recording this, but we know they will implode because that's how commodities work, because demand is met by supply. Or if it's a supply restriction, more supply comes on. So it self-regulates. Doesn't happen with these stocks. I started seeing it, and two factors were at play. One was this new business model, and secondly was the fact that the central banks had started all printing money in gigantic size and mixing fiscal stimulus and monetary stimulus into the same thing. So there was no independence of the central bank anymore. And I looked at that and thought, why are all of these companies and why are all the markets going up? Real estate, why is it going up 25% in a clip? Because the central bank balance sheet got up 25% in a clip. So I started thinking, oh, maybe we're just devaluing the value of fiat currency, the purchasing power versus scarce assets, equities, real estate, gold, crypto, etc. So then I started dividing these things by the Fed balance sheet, because let's say the balance sheet is the amount that the currency is being debased. And what happened is it kind of revealed the truth that we've kind of all felt, is that even though the market's gone up, nobody feels richer. It's harder because wages haven't gone up, but prices have. So you can afford less of these things all the time. And what is an asset? It's future consumption stored. So, you buy some gold. Why? Because you want to protect that money so you can use it later. Being able to buy less of them. So I realized that, oh my God, if the central banks are printing on average at 13% a year amongst the big G4 central banks, then that's our hurdle rate to be standing still in terms of wealth. So if you want to generate wealth, you're going to have to look for returns above 13% a year. And if you think about returns of markets over time, I mean, the S&P doesn't do that. Virtually nothing does that. So then you start thinking, okay, I need to adjust how we think about macro generated returns and what we're trying to achieve here. And that pushed me towards understanding technology and understanding, because I looked at these markets and saw the S&P, real estate, gold, they didn't really do a lot versus the central bank balance sheet. A little bit equities outperformed, gold certainly did not. And the S&P has got nowhere near where it was in 2008 balance sheet adjusted terms. And gold clearly hasn't, and real estate hasn't, but the NASDAQ had. That made me start to think, what is going on? And I saw crypto and I understood the network effect of crypto. And then it dawned on me, oh, the macro in the NASDAQ is the same. It's about the network effect. So it's become, and I wrote about this in March of this year. I mean, it came into me late March, April, May. Subscribers to Global Macro Investor are the world's biggest hedge funds, family offices, sovereign wealth funds, and everybody had the, oh God moment. I mean, everybody got it in one moment in time. Everyone realized why we were all struggling to generate returns. So I think the world's biggest macro investors have got it. That this is the new macro. All of this is now the new macro. This is the biggest secular trend we're ever going to see, which is this whole exponential age. And if our job is to generate wealth or protect our wealth, this is the absolute best way to do it. Because risk adjusted, it's far superior to anything else.